So, you want to own a trading post. On paper, the opportunity looks almost unfair. You ship blankets, knives, kettles, beads, tobacco, guns, and ammunition into a market hundreds of miles from the nearest major commercial center. In return, native trading partners bring bison robes and other furs that can travel east into a much larger Atlantic economy. The difference between what an item costs you and what it can command at the counter may be 80%. On certain goods, it may be 20 times the original cost. But you do not own a magical shop where the markup becomes money the moment a customer walks through the door. You own a stockade on the Missouri River. Your inventory arrives once the river allows it. Your returns leave when the river allows that. Your workers must be fed through winter. Your trade depends on relationships you do not control, prices your rivals can attack, and goods that may spend months trapped between your counter and the market that turns them into cash. And in 1842, you're not entering an empty frontier. You're building 19 miles from a company that already dominates the region. So what does that 2,000% markup actually buy you? And which part of this business can make those spectacular numbers almost meaningless?
You're operating on the Upper Missouri in the early 1840s in a trade shaped by native nations with their own interests, diplomacy, knowledge, and bargaining power. Your post is not a military fort. It is a private shop, warehouse, residence, workshop, and meeting place behind a timber wall. Your model is easy to describe. Manufactured goods travel west. At the post, members of the Lakota and other regional nations exchange robes and furs for goods they value: blankets, metal tools, cloth, firearms, ammunition, tobacco, beads, and cooking equipment. You pack the returns and send them downriver toward St. Louis, then perhaps onward to New York, New Orleans, London, or Leipzig. Every stage adds distance, time, handlers, and uncertainty to your money. The real Fort George gives you a sharp test case. John Ebbets began trading independently in this region with 29 men and an initial investment recorded at $5,776.60. After a successful season, he persuaded New York backers to finance a larger challenge to the dominant Chouteau interests. Their Union Fur Company built Fort George near Fort Pierre and tried to break into a market controlled by an experienced rival. You are not becoming Ebbets, Charles Kelsey, or any other historical figure. You are taking their documented conditions and putting your own capital inside them. The question is what happens to you when a promising markup meets the actual machinery of ownership. First, you need a post.
Your trading post begins as inventory and shelter, then becomes a fortified business compound. At Fort George, the builders appear to have erected a store and dwellings first, then enclosed them with a stockade roughly 165 feet by 155 feet. Blockhouses guarded opposing corners. Inside, you needed a warehouse, living quarters, a blacksmith shop, and working space. Notice what has already happened to your original investment. Before the first profitable return reaches St. Louis, part of your money has become walls. Another part has become buildings. Another part has become trade goods sitting on shelves. None of it is liquid. And the fort is only the visible asset. You also need people. A typical post requires managers, clerks, interpreters, traders, blacksmiths, cooks, hunters, boatmen, and laborers. In 1840, Ebbets employed 29 men across his ventures. By 1842, the Union Fur Company reported 65. In 1843, its license operations listed 104 men and $29,815 in capital. That looks like growth, but from your side of the ledger, growth means a larger payroll, more provisions, more supervision, more goods in transit, and more opportunities for one bad decision to become your loss. What do your employees do when the trading season slows? They still consume supplies. They gather firewood for winter. They cut hay for the horses. They maintain a commercial machine that cannot simply be switched off, because no robe crossed the counter that morning. Then there is distance. Fort Union, the great headquarters farther upriver, stood roughly 1,800 river miles from St. Louis. Fort George was closer, but tied to the same difficult river system. Goods had to be selected far in advance. Once winter closed the river, ordinary communication with St. Louis nearly stopped. So before you ask what your merchandise earns, ask a more immediate question. How much of your capital must remain committed just to keep your doors capable of opening? Now that traders arrive, the counter becomes busy, and the famous markup finally enters the story.
At the counter, the economics can look extraordinary. American Fur Company records cited in the historic documentation place markups on trade goods anywhere from 80 to 2,000%, depending on the item, post, and trader. Imagine seeing that in your account book. A manufactured item that cost 1 unit back east may be valued at several units here. A small object transported into a remote market can be exchanged for robes and furs worth far more at the end of the chain. Your stockade begins to look less like a rough collection of logs and more like a machine for multiplying value. But what exactly does the markup measure? It does not measure your final profit. It compares the acquisition value of a trade item with the value assigned in exchange. It does not automatically subtract freight, wages, provisions, buildings, losses, financing, idle inventory, damaged goods, or the time between buying merchandise and receiving cash for the returned furs. The historic documentation itself says the markup was considered necessary to cover the cost of trade and provide a return to shareholders. Necessary is not the same as guaranteed. The scale of a successful post shows why the opportunity attracted you. Fort Union handled more than 25,000 buffalo robes and over $100,000 in merchandise in an average year. Its shop could stock more than 200 kinds of goods. But you do not own Fort Union. You own the challenger. Your nearest rival has a headquarters, established relationships, experienced personnel, steamboat access, a network of posts, larger stores of capital, and the ability to absorb a bad season. In 1843, government licenses valued the Union Fur Company's trade goods at $29,815. The Chouteau firm had 119 men and trade goods valued at $58,698, more than twice your side's capital in goods. Now, suppose you raise the exchange value you offer for a robe. You may attract more trade. Your rival can respond. Suppose you lower the effective price of the manufactured goods on your shelves. You may protect volume. Your rival can respond again. Every concession helps the person trading with you and reduces the cushion inside your markup. That is ordinary competition. The dangerous part is that your rival may be able to tolerate the reduced margin longer than you can. So your impressive percentage creates a new question. Are you earning a fortune, or are you standing on a large gross spread that has not yet survived the journey, the payroll, and the competitor across the river system? Before that answer arrives, the Missouri makes its own decision about your cash.
Your inventory has 2 long journeys. Manufactured goods must reach the post before you can trade them. Then the robes and furs you receive must reach a distant market before their value becomes a realized return. Historic estimates show how slowly that second journey could unfold. From Fort Pierre, moving furs to St. Louis by steamboat could take more than a month. New York added roughly another 4 weeks. European markets could add nearly 2 months more. Even when everything worked, your money might spend an entire season changing form. Cash into goods, goods into robes, robes into packed cargo, cargo into a receivable, and only eventually back into cash. What happens if the river is low? In the spring of 1844, the Union Fur Company sent the steamer Frolic upriver. Low water prevented it from reaching Fort Mortimer, so it stopped at Fort George and spent the winter there. When it finally began its return on May 9, 1845, low water stopped it again, this time with 700 packs of robes and furs aboard. One pack of bison robes commonly weighed about 100 pounds and contained roughly 10 robes. So the cargo represented something on the order of 7,000 robes alongside other furs, tied up when the company urgently needed movement and liquidity.
You still own the cargo. That is the comforting version. The less comforting version is that the cargo cannot pay a bill while it is sitting in the wrong stretch of river. The crew transferred much of it into smaller Mackinac boats so the Frolic could return to St. Louis. The steamer made it home by May 27th, but it was described as pretty well used up after the enforced stay. Your transportation asset has deteriorated. Your cargo has required emergency handling. Your returns are delayed, and the lease on the steamer was already expensive. Meanwhile, your organization is becoming harder to control. Surviving accounts associate Union Fur Company operations with smuggling, violence, and illegal alcohol trading. Those actions were unlawful and harmful to Native communities, not clever shortcuts. They also reveal your governance failure. When employees create conflict or break the law, the consequences return to your asset. By 1844, your profits are shrinking. Your rival continues applying pressure. Your transportation has consumed capital. The market for some smaller pelts is declining. Your best employees can see the danger and may leave before you can repair the balance sheet. You can still point to the markup, you can still point to the robes, you can still point to the fort, but can you point to cash?
This is the part the 2,000% figure hides. Your trading post is not primarily a retail counter. It is a capital and logistics business with a shop attached. The markup appears at one moment in the chain. Your costs accumulate across the entire chain. You finance goods before they travel. You finance the journey upriver. You finance the fort that stores them. You finance workers through the months when trade slows. You accept robes and furs whose final selling price lies in another city, perhaps another continent. You finance the journey back. And during that long conversion cycle, you remain exposed to weather, water level, spoilage, damage, employee misconduct, changing demand, law enforcement, and the decisions of a better capitalized rival. The economic mechanism is not simply high cost. It is the combination of slow capital turnover and unequal staying power. If each cycle locks up your money for months, you cannot recover quickly from a delayed boat or an expensive season. If competition reduces the exchange advantage on each robe, you need more volume to cover the same fixed system. More volume demands more goods, more transport, more labor, and more working capital. The apparent solution makes the capital problem larger. Your rival does not need each exchange to be wonderfully profitable. It only needs to keep competing until your financing becomes intolerable. That is what an incumbent with deeper resources can do. It can overbid for robes, accept short-term losses, defend its relationships, and wait for a smaller challenger to exhaust itself. Your 2,000% headline is a gross trading possibility. Its larger capital base is strategic endurance. By May 1845, the Union Fur Company partners recognized that the contest was ending. They sold their entire Upper Missouri stock to the Choteau interests and left for St. Louis. Fort George was abandoned by mid-year. The challenger had built the post, staffed the network, leased the boat, acquired the goods, accumulated the furs, and then sold the remaining position to the rival it had tried to defeat. The markup was real. So was the failure.
So, was owning a trading post a good business? It could be, if you possess the relationships, operating knowledge, transport access, discipline, and capital to survive the full cycle. Fort Union proves the model could create value. Fort George proved that copying the visible asset did not give you the invisible advantages behind it. You could build the walls, you could fill the shelves, you could hire more than 100 men across the operation. You could hold goods marked up by hundreds or even thousands of %. None of that guaranteed that cash would return before your obligations consumed you. For you, ownership meant carrying construction, inventory, payroll, transport, compliance, relationships, price risk, and months of delay. The robes looked like wealth, but until they sold, they were working capital wearing fur. Who held the safer position? The established firm with deeper capital and control over the network could sacrifice margin today to preserve dominance tomorrow.
Transport providers and Eastern suppliers could be paid for moving and furnishing the trade even when your final return disappointed. And when your challenge collapsed, the incumbent could buy what remained. The owner captured the romance of the fort and the upside of the markup. The network captured the resilience. That is the verdict. You were not defeated because the goods lacked value. You were defeated because value and liquidity were separated by distance, time, fixed costs, and a competitor that could afford to wait longer than you could. And your final asset? Within years, much of abandoned Fort George was dismantled or burned for reuse and steamboat fuel. The walls that once represented your commitment of capital ended as raw material for someone else's journey.
If you found this useful, subscribing genuinely helps. The channel is small and everyone counts. Next time, we are going back to sea and to a document. You want to see what happens when the owner controls the ship instead of waiting for one? Continue with the economics of owning a privateer. The asset moves, but so do the risks, the financing needs, and the people who claim the safest return. This is Owning History, where history opens its account books.